Hey guys, Reece here, and welcome back to my channel today. Real estate is a pretty diverse industry with a lot of different ways to make money as well as lose money. You have your home buyers not necessarily looking to make money, your wholesalers, your flippers, your buy and hold investors, your real estate agents, brokers, and many other people trying to make money through real estate. In my last couple videos, I touched on how I'm a buy and hold investor focusing on the BRRR method, which is to buy properties, renovate them, rent them out, and refinance them to pull the cash out. And my favorite part about this strategy is that you're still holding that asset that will over time on average go up in value, increasing your net worth, as well as cash flow every month. And today I'm going to compare this method, the BRRR method of real estate investing, with flipping. And the reason I'm going to do this is kind of showcase the reasons why I don't like flipping and I probably will never flip a home, and why the BRRR method of investing for my specific goals is substantially better. However, keep in mind, like I just said, this is for my goals. Many people make a lot of money flipping homes, and I have a few personal friends that do flip homes, that's all they do. They flip homes to make money. However, there are different priorities between flippers, long-term buy and hold investors, and the other groups I mentioned trying to make money in real estate, and my priorities line up with the BRRR method the best, and so I'm going to go over some of the pros and cons of flipping in this video. So guys, before we really dive into it, please go ahead and like this video, as well as subscribe if you're new to the channel. I'd really appreciate it, and it helps me out a ton. So thank you very much, I really appreciate it, and let's dive right into the video. So for those of you unfamiliar, I briefly touched on what BRRR real estate investing is, where you buy property that's in need of renovation and therefore relatively cheap compared to the market. You renovate it, you rent it out, and then you refinance it to pull cash out, and you have that money available again to go buy another property. This is very cool because you have that money available to you again, but the previous property you still own, it's still cash flowing. Meanwhile, flipping is pretty much the same process of finding a property that's in need of renovation, renovating it, but then you sell it, you flip it to somebody else who's looking for that turnkey home, turnkey rental property. And this process can be fairly quick, and you turn around and take your profit. However, you don't own that asset anymore. So your net worth is not increasing month over month on average because home prices rise on average. And you're also not cash flowing anymore, so if you decide to never flip another home, no more money is coming in. So when it comes to comparing these two methods, I'm going to go over 4 reasons why I prefer the BRRR method of investing and will probably never flip homes. And the first one is that flipping doesn't align with my goals. Now this is probably the biggest reason why I don't flip homes, and it ties in the rest of my points I'm going to make in this video. My primary goal as a real estate investor is to build that sustainable passive income. And that's just not a priority with flippers. Once you sell that home, you've made your profit, yes, but you've cut that stream of future income that comes from the cash flow of buy and hold investing. And so when I invest, I do look for that strong value add so I can refinance and pull that cash out and keep my business moving, as the availability of that cash really speeds up the process of growing my portfolio. However, I will only buy deals that have strong cash flow even after refinancing, because that's my number one goal, that passive income coming in every month, that if I decide tomorrow I don't like real estate anymore, I can close up shop and I still have that money coming in every month and my net worth increasing from the average appreciation of those properties I still own. And I talk about this in a few different videos. However, there are so many business models out there that make money. The true issue and the true thing you need to focus on is what are your goals and priorities and what business model fits those best. If I'm somebody who prefers a stress-free lifestyle, then I might not want to be a short-term investor flipping real estate because of all those short-term loans coming due that are stressing me out. So that's something to consider. Number one, keep in the forefront of your mind, what are my goals and priorities? Number 2 is the tax consequences of flipping versus buy and hold real estate. I like putting my efforts towards the most tax efficient ways to make money. So that's why I don't focus too heavily on being a real estate agent, because it's taxed as ordinary income. Whereas buy and hold real estate adding value, when I eventually sell, which I may not sell for 30 years, that will be taxed at the capital gains rate. Now when it comes to flipping houses, the surprising thing, and something that many new investors don't understand, is that flipping houses is actually considered an active business, and in the IRS tax code you're considered a dealer that is taxed at the ordinary income rate. not the capital gains rate, which is substantially lower. And so your federal tax rate here will be somewhere between 10 and 40%, not including that you have to pay self-employment tax, which is another 15.3% or somewhere around there. And you still usually have to pay state income tax if you're in a state that has state income tax. And so you could very well end up paying 50+% of these profits from flipping houses just in taxes. On top of this, there's certain tax write-offs you can't take advantage of as a flipper that you can with buy and hold real estate, such as depreciation, and you're not eligible for 1031 exchanges, which allow you to roll capital into new like-kind investments without paying taxes on them. As a long-term buy and hold real estate investor, even if I am still renovating and adding value like I am in the BRRRR method, I'm not selling immediately, and therefore these properties are eligible for the capital gains rates, which can be 10 to 20%, and you don't have to pay self-employment tax. In addition, you can write off depreciation, you can 1031 exchange the sale of these properties into new properties to scale up. And so these are really huge tax consequences. The other cool thing is if you're a new real estate investor and you're just looking to buy 1 or 2 properties, well, if you live in this property for 2 years, renovate it while you're living in it, then if you're single, you can actually take $250,000 in profit tax-free, or $500,000 if you're married, which is super, super cool and something you can't do as a flipper. Now the cool thing is that through the refinance with the BRRRR method, I can still pull out 75% of the value of my property. And so I'm taking advantage of a lot of the value added to these deals without selling them and taking the tax consequences of flipping. When you refinance, it's not actually a taxable event, so even if I were to say pull out $100,000, I don't owe taxes on that money just yet. And like I said, when I do sell and owe money, then I can use a 1031 exchange, which is not eligible for flipping. Okay, so the third reason I don't flip houses is the sustainability of the business model. As I stated earlier, flipping is considered by the IRS an active business, while buy and hold is considered investing and not an active business. And I know many flippers that might be watching this video, they might chime in and say, well, flipping doesn't have to be active. You can build the system, build the team to manage your flipping pipeline where you don't have to do anything anymore. However, that still takes team oversight. And one of the great things about buy and hold real estate is that even when I 100% stop, the cash flow comes in. If you were to completely give up on this team you've built and fall off the map, that business will eventually break down or will become less efficient, and you'll start to not make as much money. The other thing is, if I build up a portfolio of, say, 10 assets that are each worth about $200,000, an annual appreciation of 3% on $2 million is $60,000. So my net worth is increasing about $60,000 a year on average, as well as I'm cash flowing off these properties while not doing anything while taking a monthly call from my property manager. This isn't including the principal pay down that the tenants are paying off for me. That might be 2 flips every year that flippers need to complete just to make up for the fact that they don't hold the property and they're not taking advantage of the principal pay down, the cash flow, and the appreciation. Now, as a flipper, you don't make any money until you sell this flip for a profit. So what happens if you sink 3 months into a flip, the market tanks, and you now break even? Or you lose money? Well, that was time wasted. The BRRRR method, like I said, fits my lifestyle. If you want to grind every day and make lots of money, then flipping might be a good option for you. However, I really like to grind occasionally and then just press pause and still have that money rolling in. My fourth and final reason is that flipping is a short-term investment model. As with the stock market, you have short-term traders like day traders and swing traders, and then you have long-term investors who buy and hold for many, many years. And neither one is necessarily wrong, and lots of money can be made either way. However, I prefer to be a long-term trader. And so translate this to real estate, your flippers and your wholesalers are your short-term, and your buy and hold investors are obviously your long-term, and the BRRRR method is a subset of buy and hold. As a flipper or a short-term trader, you need to be aware and concerned about short-term fluctuations in the market, as things like a massive pandemic we're seeing right now can throw off your profit on all the deals you're working. Meanwhile, as a long-term investor, The value of my assets might be going down right now, but I don't really care because the cash flow coming in has stayed the same. Rental rates through history have shown to not fluctuate as much as the value of homes. And therefore, as a long-term buy and hold investor, I really just need to pay attention to the macroeconomic trends of my market, like increasing or decreasing vacancy, population increasing or decreasing, and wage growth, things like that. Now, as a flipper, you're not concerned about the cash flow of a property because if things work out well, that property's vacant, you renovate it, you sell it, and you just factor in those holding costs into your renovation budget. This is, of course, fine when the market's doing well, but if the market takes a turn for the worse, this could be a disaster. If the value of the property drops, you still need to sell as a flipper. Usually, most flippers take out short-term debt on these properties, such as 6 to 18 months, that give them plenty of time to renovate and sell in a great market. However, it also forces them to sell in a bad market and break even or even take losses on a deal unless they refinance into long-term debt. But the issue is, if you weren't concerned about cash flow in the first place, these properties may not cash flow even when rented out. The BRRR method is a little bit more forgiving, especially for a new investor, as if you go over a little bit on your renovation budget, that's not going to kill your business. You can pay off that overage through the rental income coming in over the next decade. And so therefore, I personally am much happier with this long-term stress-free profit from buy and hold investing. Sure, like I said, I can refinance and pull cash out if the market's good, but if the market's bad like it is pretty much right now, then I still have the cash flow coming in to pay my bills and to provide me with a little profit. So everyone, once again, this is the 4 reasons why I personally don't flip houses. Many people, once again, make a lot of money flipping houses, and they have well-oiled machines that don't take a ton of their time. But the investment strategy personally doesn't fit my goals, which is a deal breaker for me. Build your business around your goals. You can make a lot of money flipping. However, it's not the most tax-efficient business model to make money, and therefore I'm going to prioritize other avenues. If you are still interested in flipping though, even after watching this video, please consider watching Mark Ferguson's channel, as he is an active flipper and he does have a lot of good advice on his channel. So I'll link it above here somewhere for you guys to check out if you're interested. So guys, thank you so very much for watching to this point. If you like this video, please leave a like on it, as well as subscribe to the channel if you're new here. I'd love to see you back in the next video. Really appreciate you all, and I'll see you in the next one. Have a great day, guys.